I'm with Tim Carleton, Chief Investment Officer at Auscap. Tim, thank you very much for participating in the Inside Network's Investment Leaders Forum, Byron Bay.
Thanks for having me.
Great pleasure to have you here. Tim, active management has faced challenges in recent years. The SPIVA scorecard doesn't lie, only a small proportion of managers outperforming passive strategies. What do you believe sets successful and persistent active managers apart in this environment?
Yeah, we think one of the biggest things is discipline. So sticking to your process and really focusing on the high quality businesses that are in the listed market. High quality businesses tend to have higher return on capital metrics, and that's indicative of the fact that they have some form of competitive advantage over their peers that allows them to earn superior return on capital metrics. So if you focus on the high quality businesses and then you're disciplined around the price that you pay, in other words, you're patient and waiting for the opportunities to come to you where those high quality businesses are trading at attractive prices, that will set you up for long-term success. And really, our core belief is that over time, your returns are going to be a function of the dividend yield that the company pays today and the earnings growth that that company is going to deliver over time, as long as you don't overpay for those businesses. So if your focus sticks to the businesses that look like they have some sort of competitive advantage to deliver superior revenue and earnings growth, and you're disciplined around when you add to those positions, I think that guarantees some form of long-term success.
Concentration risk is on everybody's minds these days, far more than usually. We all know the Australian benchmark is heavily weighted towards financials and materials. Many large cap companies are almost exhibiting low growth or are even considered X-growth.
Yes.
How does that shape your approach to portfolio construction, and where are you seeing the strongest opportunities or best opportunities outside those sectors?
Well, there's this whole debate about passive and active investing, and a lot of people don't think beyond the first layer, which is the fee layer. But some environments and some markets are set up for passive investing to work really well. If you're passively invested in a market where the biggest companies in that market that you're naturally overweight through a passive investment are growing their earnings really strongly, then a passive solution is going to be fantastic. If you're in a market where the biggest companies are actually poor performers and are likely to deliver flat to negative earnings growth over time, then actually you want to look for an active manager that's going to deliver better returns than the broader market. So if you think about the domestic market, we've got a lot of banks that haven't grown earnings for a decade. We've got the iron ore companies that are probably on the wrong side of the China super cycle. So we think the best opportunities for long-term returns driven by sustainable earnings growth are outside of the ASX 20, and that's where we're heavily focused. There's a large part of the mid-cap market that are already dominant businesses in established fields that we think will continue to grow earnings at above system rates for a long time, and they're the businesses that we're really focused on.
So it's that stratification by capitalisation that can really work for investors who look at the deeper market beyond the ASX 20, and as you said, some mid-caps have performed really well in terms of earnings growth, and the mid-caps index has performed a lot of the other ASC indices. So is that a sector that is both compelling for active managers and really throwing up great opportunities?
Yeah, so our focus over time has always been the mid-cap universe for precisely those reasons. So we are invested in a few stocks in the ASX 20 that we continue to believe will have a long-term opportunity to grow revenues and earnings above system. But the really exciting opportunities tend to be in the mid-cap universe because you're not taking a risk that these businesses are unproven. They're already generating a lot of revenues and a lot of earnings. They've got some sort of competitive advantage, particularly in the Aussie market where we see quite a lot of oligopolistic situations. And yet there's still lots of opportunities for future organic revenue and earnings growth. They haven't exhausted their market like a lot of the ASX 20 companies have. And that leads to superior earnings growth over time, which leads to better performance. Our core belief is that the longer you stretch duration, the more your total return will be a function of the dividend yield you receive and the earnings growth that the companies deliver. And so you really want to focus on businesses that can deliver above system growth and then make sure that you don't overpay for those investments in the first place.
And what's really interesting, Tim, is when you look outside the 20 and all of a sudden your industry weightings change and you are literally looking at a different share market.
You are. I mean, we have an X20 product that benchmarks against an ASX 300 X20 index, and it's a much more diversified index. It de-weights the banks, it de-weights the mining companies, and as a result, it's a much more attractive benchmark. It's outperformed historically compared to the All Ords, precisely because there are more companies that are delivering stronger earnings growth over time than the All Ords.
Now, you mentioned China and iron ore, and its dominance in iron ore demand has been a major theme for Australian miners, and thus the Australian share market, if we look at that top 20. But Chinese steel consumption peaked in 2020. We've got supply, much more supply than ever before, coming as West Africa starts to be active as an exporter of iron ore. So how should investors think about the long-term implications of that iron ore trend for Australian equities? I mean, some of our majors are very heavily exposed. Are their margins going to hold up even if in a much lower iron ore price environment?
Yeah, well, you've hit the nail on the head. If we think over the medium term and forget what's happening on a month-by-month basis or over the next 6 months, if we look over the next 5 to 10 years, we would be confident in making the assumption that Chinese demand will be lower than where it is today. It looked like it peaked in 2020, but it's still well above where most other developed countries are in terms of their consumption on a per-person basis. So as that declines and reverts to trend, that has a material overall impact on iron ore and coal demand because at the moment China are in excess of 50% of the world's demand for steel. So on the one side you've got demand destruction, and then on the other side, as you pointed out, we've got Simandou coming on in the next couple of years. So you're going to see a material number of tonnes come into the market. Now that equation suggests to us lower prices. And so you're in an environment where they're likely to see lower revenues, and yet on the other side we're continuing to see cost inflation, which will ultimately result in negative jaws for both for all of the major mining companies as revenues decline but their costs keep escalating. So, we suspect that a lot of those iron ore companies over this coming period will actually deliver negative earnings growth, and so you're going to want to look at other spaces, other sectors, other parts of the market to deliver your earnings growth and deliver your returns.
So looking ahead, what are some of those sectors that are attractive, and what are the biggest risks around those opportunities or that exist in conjunction with those opportunities for Australian equity investors, and how should advisors be positioning their portfolios in equities over the next decade?
Listen, the opportunities are quite significant across the board. So at the moment, we're spending a lot of time looking at a lot of the great healthcare companies that now have valuations that are much more reasonable compared to where they were 4 or 5 years ago. We think there's great opportunities in the communication space, and there's always been an abundance of great high-quality companies in the consumer discretionary space that have delivered incredible earnings growth over time and are still trading on very modest price-to-earnings multiples. So, it's a happy hunting ground across the board. You have to be patient and disciplined around price. Don't overpay for a company that looks like they're doing great things today. Wait for the opportunity when, no company grows earnings in a straight line. Companies will have a hiccup. You often see a PED rate at the same point in time. They're the sorts of opportunities that we use to enter into or add to some of our positions in the fund.
Tim Carleton from Auscap, thank you very much for participating in both this interview and the Inside Networks Investment Leaders Forum, Byron Bay.
Thanks. It's a pleasure.